I've come to the conclusion, and it's actually a pretty, it took me a long time to figure this out, but I think for most of you it would seem obvious, is if there is such a thing as a best approach out of all of these approaches, the best approach I think would be one where one focuses on multi-baggers. When we look at this large tent called value investing, it encapsulates quite a range of approaches and focuses one could have while trying to create wealth and generate good returns and so on. So, for example, buying a dollar that is trading for 50 cents would be a great way to be a value investor, focusing on cannibals, which is companies that are buying back their stock, looking at what I call spawners, which is businesses that are really good at creating new businesses and then spinning those off. So that's another way one can go. Focusing on multi-baggers is also well within the tent of value investing. One could do special situation investing, merger arbitrage. It's a long list of endeavors and initiatives. Ben Graham suggested net investing and so on. So there's many different approaches one can take, which would all be within the tent of value investing. They say that you're old too soon and wise too late. And I've made investments over the last quarter century or more, which have covered pretty much almost all of these. I've come to the conclusion, and it's actually a pretty, it took me a long time to figure this out, but I think for most of you it would seem obvious, is if there is such a thing as a best approach out of all of these approaches, the best approach I think would be one where one focuses on multi-baggers, businesses that can be a 10x in 10 years or less, or maybe a 100x in 20 years or less. So the multi-bagger approach to investing has a few quirks, and it requires us to kind of change our mindset on a few fronts. So one of the changes one has to make is that traditionally when one looks at what Ben Graham, kind of the father of value investing, taught us, is that you buy something for well below what it's worth, and then as it approaches fair value, you sell the position, and then you go look for something else. But in the multi-bagger framework, what you would do is you would actually not particularly care if a position became fully valued or even overvalued. So, for example, if you bought a business for 30, 40 cents on the dollar, and it's growing, that dollar is growing, and at some point it's worth $1.50, for example. It's gone up more than 50% over what it used to be worth. But the stock is trading at $2, for example. So under traditional Grahamian approaches, you would sell that as you get past the $1.50 or whatever. But in the quest for multi-baggers, you would continue to keep it in your portfolio even when it became overvalued. Let's look at some examples of businesses that might help explain kind of where this approach is coming from and how it might work and so on. So if we look at a business, let's say McDonald's, for example, I think they went public in the 1960s. It's been public for maybe almost 60 years since then. It's still growing. The number of restaurants, revenues, profits, etc. I mean, it's gone through some ups and downs over the years, but it's grown, and it's grown spectacularly, like a 10,000 plus bagger. But the interesting thing about something like McDonald's is that almost all the innovations they came up with, there were a lot of copycats. And there were many businesses that came up that cloned or tried to clone what they were doing. And in general, fast food became a huge industry with many players. But anyway, even with all of that competition, McDonald's was able to establish a brand. People knew before they went into a restaurant, any McDonald's, what to expect. The kind of standardization and consistency, the cleanliness, the consistency, and the nature of the service worked. So that particular moat has been going strong for 60 years. There aren't really any signs that say that the moat is eroding and may not do so well in the future. They continue to do well. And it's a very high return on equity business. If you picked up the annual report of Walmart, let's say in 1980, for example, a few years, 7, 8 years after they went public, you would see that they've got very superior economics at the store level, that they generate high returns on equity. It's a business that does well. And you would also see that it was embryonic in the sense that large portions of the United States at that time, 1980, still did not have a Walmart. So you could see that basically this business could actually, if you just looked at it in North America, there was a lot of room to grow. And we could look at other businesses like, let's say, the Coca-Cola company. The Coca-Cola company was formed about 130 years ago. And that moat is still growing after 130 years. And again, the unit economics are extremely attractive because the Coca-Cola company typically doesn't do bottling. They sell the syrup. So again, it's very similar to McDonald's in terms of economics. So basically, there are businesses, different kinds of businesses. You can look at a business like MasterCard or Visa or American Express, and they have similar attributes. So the three legs that we need, I think Chuck Akery called it the three-legged stool. The three legs that we need for these long multi-baggers is, first of all, the core economics of the business should have very high returns on invested capital, ideally without the use of debt. The second is that we want very high integrity management, and we want insider ownership, kind of alignment of interest. And the third is that we want a very long runway. So where we can see that this thing can go on for a very long time. So if one pursues these now, the nature of capitalism is that everyone wants to own these kinds of businesses. Once these kind of moats and, runways, etc., are well known, the businesses get priced to perfection. And they may not be available at a cheap price. But the interesting thing is that if the runways are really long and they actually end up being runways that go on for, several decades, then even an expensive looking price can end up being a great value investment. But I think that as value investors, we have to also have a good dose of skepticism in how we approach these things. So we can't always assume that everything's going to go to the moon in terms of size and growth. And the nature of capitalism is that there will be a lot of competition that will try to go up against those moats. And as long as you're willing to put in the work to sift through company after company, with the framework that you're interested in. So in the case of the multi-bagger framework, there are just three things that matter. And then the fourth is the price, obviously. So if a business doesn't generate high returns on equity, you're done. You don't need to spend any time on that. If the business needs a lot of debt to grow and generate high returns on equity, you would also be done. You don't even need those. If management quality or ethics is a question, you're also done. You don't need those either. And so just if you look at the businesses that generate high returns on equity, that alone would wipe out large swaths of businesses.